Welcome, everybody. Thank you for joining us today. My name is Sean Moss with Down Payment Resource. You are joining part 3 of our 6-part homebuyer education series. Today, we are going to talk about mortgage products and mortgage options. We have in the past covered the housing counselor role and the value of housing counseling services and their objective support for you as you endeavor toward home ownership. Then we covered the loan officer and the role of the loan officer, their processor, and their team, and going through the mortgage process. We talked a bit at each of those webinars about mortgage products and mortgage options. Today, we're going to dive into that, and we have a couple of guest speakers that are really going to help us dig into the details of mortgage products and how they work. So as you explore housing finance, as you explore financing your home, we want to talk about the specifics and some of the terms that you need to know about mortgage products themselves and how they work and how they might differ. We will continue on with this series covering homebuyer education, the real estate agent, and what successful home ownership looks like after you close on your home. Now, we also have Melinda Harris and Fern White and Tamara De La Cruz and Veronica Candelwald in the background from our down payment resource team. Please keep this interactive. Ask your questions in the questions box. If you have comments, if you're curious about anything, if you didn't understand anything that you heard, fire away, ask questions, keep it interactive. We also have Maheen and Sandra from Freddie Mac. We're going to introduce them shortly. They're going to additionally be in the background helping answer questions, and we're going to engage in some dialogue with them about mortgage products. Today, specifically, we want to cover the mortgage options that are available to you. We want to talk about the down payment requirements and mortgage insurance requirements and how they differ among some of the mortgage products that you will be looking at as you explore home ownership. And in particular, we're going to talk about some of the specific benefits of what we call conventional mortgage financing, in particular, Freddie Mac's Home Possible Mortgage and their Credit Smart program to help you get to mortgage qualification. So before we move on, we actually want to ask a poll, and if I can ask Melinda to put this poll up on the screen, we want to know where you are in your home ownership journey. We have a lot of people joining this webinar, but you are all somewhere in the home ownership journey. You can click your answer on the screen here, but tell us, are you just thinking about home ownership? Are you looking at homes online? Have you taken the step of talking with a housing counselor to review credit, budget, spending plans, considering mortgage options and so forth? Maybe some of you have already started working with a loan officer to get pre-approved or to get pre-qualified. Or if you're working with a real estate agent looking for homes, you've already been pre-qualified and now you're home shopping, let us know. Or are you under contract for a home? So at the tail end of the process, looking at ownership very soon. We're just curious where you are in your home ownership journey. And we want to make sure that we speak to your needs, we speak to your experience, and we speak to what's coming next for you based on where you are in that home ownership journey. So Mel, when we get to critical mass here, let's share the results real quick. So most of you are past the point of just thinking about it. In fact, this is a big portion of you are browsing homes online. And that's good. That's good. It's exciting. It's compelling. But we want to make sure that the next steps you take are the appropriate steps in the appropriate order to get the information, the education, and the pre-qualification that you need so that you can get to home ownership sooner and faster, more responsibly, and with the support of the team that you need to build around you. So for those of you talking with a housing counselor, that's great. That is a great next step, and it's why we started this series with that step. From there, talk to a loan officer. If you're working with a real estate agent, we hope that you've been through pre-qualification, spoken to a housing counselor. But what we're going to talk about today is mortgage products. It's going to come up when you talk to a housing counselor. It's absolutely going to come up when you talk with your loan officer. And you may even get some insight from your real estate agent, especially if you find a loan officer through your real estate agent. So what we want to do today is focus very heavily on mortgage products. What are the mortgage options that are out there? And in just a moment, I'm going to introduce our guest speaker, Sandra Heidinger from Freddie Mac. She's an affordable lending manager on their community outreach team. And she's going to walk us through a lot of what Freddie Mac is offering and what they do on behalf of home buyers, especially first-time home buyers. Before we get into dialogue with Sandra, we at Down Payment Resource track and monitor all of the homebuyer programs around the country for down payment assistance, closing cost help, and tax credits and more. And many of you came to this webinar because you had been to our website looking for down payment programs. Our primary goal is to raise awareness of down payment assistance programs and put them in front of you as you explore homeownership, so you can truly explore all of your home financing options. Now, I want to quickly give you a basic overview of some of the most common mortgage programs or products that are out there. I'm going to start from the bottom here. If you are buying a rural property, some of you may hear the term USDA or RD, Rural Development. This is from the U.S. Department of Agriculture. This is a mortgage for properties that are in rural areas and does come with an upfront fee. It does have an annual fee. We're going to talk about what those mean once we dig in with Sandra. But basically, the monthly fee is mortgage insurance or MI. You might hear it called private mortgage insurance or PMI. But a USDA loan does have an upfront fee, does not have any down payment requirements, but it is limited to buyers buying a qualified rural property. You may hear VA. If you are active military or a veteran or even reserve or guard, if you have a military background, then VA might be an option you want to explore, getting a loan from the Veterans Administration. They do not have down payment requirements either in most circumstances, certainly for a first-time eligible user. There are upfront fees that can be up to 2.3%, and there are no monthly mortgage insurance or other fees. You do, however, have to be eligible military. Now, what you may most often hear, if you're not buying a rural property or you're not a member of the military or armed forces, you're probably looking at FHA versus conventional. And those are two terms you're going to hear come up with your loan officer. With FHA, 3.5% down payment requirement. 3.5% of the sales price of the home you want to buy, you have to have up front as your down payment. It also comes with an upfront fee of 1.75%, basically mortgage insurance you pay up front and you include in your loan amount. Conventional loans can have 3 to 5% down payment requirements, no upfront fee, and then when you get into the monthly payments, typically you'll see lower monthly mortgage insurance or MI, that annual fee, on a conventional loan than you will FHA. Now, FHA may be a little flexible with credit and credit score and so forth, but if you can get to conventional financing, and we're going to talk about that from Freddie Mac here in just a moment, that's where you're going to see the lowest fees, the lowest mortgage insurance, the annual fees, no upfront fee, and we're going to get into down payment requirements and some of the other requirements and benefits of conventional financing. Ultimately, if you can get to that with your own savings, with down payment assistance, you're probably getting the best option with both upfront costs and long-term cost and value. So I know that's a quick overview, but what we really want to do is dig into conventional financing. We want to kind of set that as your goal. And I want to introduce Sandra Heidinger here. In fact, Sandra, I'll let you introduce yourself and just tell us a little bit about yourself, and then we'll get into what Freddie Mac does.
All right, so let me unmute myself, and thank you so much for that, Sean. So I am an affordable lending manager at Freddie Mac, and what my role is at Freddie Mac is really to work with our lender partners, making them aware of the low down payment mortgage options that we do have for borrowers, consumers, just as yourselves. Because so many people think that FHA is the only option out there for maybe a first-time borrower or for someone that doesn't have the full 5 or 10% or whatever to get into a home. So we want to make sure that everyone is aware of those product offerings that we do have to help you be able to make home possible for yourself and achieve that dream of home ownership. So I've been in this industry for, oh my God, Freddie for 23 years, and then prior to Freddie in the primary market, and I don't want to see all of you doing the math. So yeah, I've been in this industry for quite a while, but this has always been my favorite space because it kind of, working for a company like Freddie, we have our own mission. If you'll go to the next slide, Sean. We have our mission, which kind of meshes up with my own personal mission. But we were chartered by Freddie Mac back in 1970. And believe it or not, on July 24th, we just celebrated our 50th birthday in this market, in the secondary mortgage market. And what is our mission, you may ask? Our mission is to promote liquidity, stability, and affordability in housing. Again, it's all about responsible and sustainable home ownership. That's what we are here to do. Trying to help stabilize communities, expand credit responsibly, educate people like yourselves for future home ownership. Also to prevent foreclosures, because we know sometimes life happens and we want to be there to assist you. But that's truly what we are all about. And I know when you're listening to me, you might be thinking, well, who are you and what's really your role in this whole thing, right? Do you do the mortgages directly? No, not directly. As we look at the next slide, let's just do a quick little walkthrough on how it all kind of works. Because you really are not going to see us. You would see our lender partners in the space. So, and all of those that are in the ecosystem that are trying to assist you to achieve that dream of home ownership, because it does take a village to make home ownership a reality and a possibility. So it starts with yourselves, right? You're doing that research, just as the poll that Sean just took, trying to see where you are in that process, right? Whether or not you are already talking with a real estate professional, whether or not you are talking with a housing counselor, wherever you are in that process. But once you are ready to roll, then you're going to go to that lender and, you know, you've got your contract. Now you're ready to make a loan application. That's where you go to the lender. The lender will process that application, get you all the way through to closing. Once that loan closes and you now have the key in that marketplace, it's a key to your home, then what they do is they sell that mortgage. They package and sell all of those loans either into the industry. And in my case, let's say they're selling it to Freddie Mac. So what that does for them, it frees up the money that they have so that they can continue lending in the mortgage marketplace to people, to more borrowers in this space, right? And from there, what we do is we package and sell into like Wall Street. That's really the cycle of how that works. Now, just to give you a little bit of context, let me tell you what we have actually done just real quickly over the last 50 years. So over the last 50 years, since we have been in this space, we have funded 10.4 trillion with a T mortgages, which equates to about almost 80 million people that we have made home possible for. Hey, that just warms my heart knowing that we've been able to help that many people to be able to get into a home. Of that, 5.6 million are first-time home buyers that we've worked with. And through the housing crisis that we've recently come out of, that was starting around 2008-9, we helped 1.9 million of those borrowers prevent going to foreclosure. I mean, needless to say, I know we're very proud to work for a company like Freddie Mac that's been able to accomplish all of that. And all of that said, as we look at the next slide, we are all in. We are all in this when it comes to responsible and sustainable home ownership. Because we not only want to help you be able to get into a home, making you aware of the tools, resources to get you into a home, we want you to be able to stay in that home, right? Be successful in staying in that home. But we are all about opening that door and reducing those barriers and making sure that you are able to achieve that dream of home ownership. So as we start into a little more engagement here, I know there's conversations out there that you guys all have, and I know everybody thinks they know everything, right? But we don't know what we don't know, right? And there's a lot of myths that are out there, a lot of misconceptions out there. So I think Sean and I are just going to have a little conversation and see if we can bust a lot of those myths, a few of those myths that are out there right now.
Yeah, this is a huge part of what we've been trying to do for 12 years, and especially this year. There are a lot of misperceptions out there about how much money you have to have as a down payment. And in fact, I'll do a sort of impromptu survey. Throw it in the chat box for us. How much money do you think you have to have as a down payment to buy a home, or what percent of your purchase price? Just whatever your off the cuff answer is. Throw it in the chat box, and while they do that, Sandra, so what are, well, maybe we'll get to misperceptions here in a moment, but let's talk about first, what are some of the things that we can do to reduce barriers to homeownership for first-time home buyers, low to moderate income buyers? What is the impact of a DPA? Where can you get your down payment from? Let's talk about that for a moment.
Absolutely. Absolutely. So the main thing is really all about educating yourselves and really learning about what is out there. What is the truth to me that can help me get in? That way it will help be able to reduce some of those perceived barriers, because again, we don't know what we don't know, right? And that's why we're so happy to see all of you here today, so that we can knock down some of those barriers.
Yeah, when we talk about down payment, so we're sort of asking the impromptu question, how much do you think you need? Where does down payment come from? A lot of people might think, well, the only way I can get a down payment is to save that money myself for years. And we're going to look into some data. We're going to look at some data that's going to show how difficult that might be. But we talk about on the slide here, flexible sources of funds. What are those? We track down payment assistance programs, but where else might one get their down payment?
Well, they could possibly get down payment from either local city governances, municipalities. I know a lot of cities do offer down payment assistance. The Federal Home Loan Bank, as an example, offers these affordable seconds, if you will. And that's basically money to be able to help you be able to get into a home. What about employers? Some employers also offer their employees down payment assistance to be able to get in. And of course, I can't ignore right here with you down the resource that you have available, the website that you have to be able to search and find out a lot of those sources to be able to get in.
Yeah, and that's a great point about employers. We would encourage everybody here, ask your employer, talk to human resources. And it depends on how big or small the company is you work for, but see what your employer offers, because you never know, and it doesn't hurt to ask. We hear a lot about you could borrow from your 401k, you could get a loan or a grant from family. We're going to push you in a different direction, because if you think about the long-term impact of things like that, or the distress it may cause among the family, if it's an option, great, but there are other options out there for you as well. And to clarify, I'm going to open up the chat here, and actually, Mel, if you can just rattle off, what kind of numbers are we seeing? What do people think they have to have as a down payment?
I think the average is probably 3%, but a lot of people said 10% as well. Some said 20. It's kind of all over the board, but I see a lot of 3 to 5% and 10%.
Okay. All right. So let's tackle that. So 3.5%, that'll get you an FHA loan. All right. But let's talk about down payment requirements for conventional financing. Sandra, what do you really have to have? Clearly not 20%, right? Oh, did we lose Sandra? Maheen, I don't know if you want to step in here while we wait on Sandra to get back, but can you talk to us a little bit about down payment requirements for Freddie Mac financing, conventional financing?
Sure. Can you hear me okay, Sean?
Yes.
Okay, well, Sandra really is the expert here, and we'll make sure she comes back. But absolutely, at Freddie Mac, we offer some low down payment mortgage products. Home Possible and Home One are the two products that you want to keep in mind as the conventional conforming mortgages. And as I think everybody's talking about, it's pretty much a myth that you need, 10% or 20% down to get into a home. So Sandra, I know, is going to be able to share a little bit more detail about those. But like I said, 3%, 4%, 5%, if you've got that and you can qualify, you can get into a home and get a conventional mortgage.
And that can make a big difference for somebody in terms of how long they need to save, how long until they get to home ownership. Sandra, you back with us?
I am so sorry. I don't know what happened there. My apologies.
No worries. So when we talked about down payment requirements, Freddie Mac has some products, Home Possible, Home One. We're going to look at those. We're going to dig into the details of those here in a moment. But a couple other myths, let's dispel a few of them. If you've got student loans, you can't buy a home. Fact or fiction, Sandra?
Fiction. Fiction. Because the thing that you need to look at, we hear that a lot, that student loan can be a big obstacle. But a lot of folks don't have as much debt, given what our statistical folks are showing us. It's not as great as what people are saying. But the one thing I do want to point out there is how we look at debt when we're looking at student loan debt. We only count when the lenders are pulling your credit report. They will either use the payment that's stated on the credit report, or if there's nothing there, only 1/2 of 1% of that outstanding balance. Where when you compare that to like an FHA loan, for example, they use a full percentage point. That can make a huge difference in your debt load when you're looking at qualifying for a mortgage. So definitely an advantage to be able to looking at us when you're talking about a mortgage. I mean, talking about the student loan.
Yeah, and that makes a big difference in terms of the purchasing power too. So guys, if you think about your income, if you've got to count more of your student loan payments against your housing budget, then you're able to afford less house. So let's just be crystal clear. Student loans are not an obstacle to home ownership. If you've got student loans, do not sit around and wait and suffer the misperception that you can't buy a home. You just need to figure out how much home you can buy, accounting for the fact that you do have student loans. So we'll dispel one other myth here. Sandra, well, we've kind of already talked about this, but FHA, that's the place for low down payment mortgages. That's the place for first time home buyers. Fact or fiction?
It's not the only place for first-time home buyers. It is an option, but this is not the only place. There are other options out there for low down payment, some of which we're going to be talking about today, that 3%. Because I think there is a misperception out there of, okay, I'm a first-time home buyer, I have to go FHA. No, you don't. And I think so many consumers tend to think their credit is worse than it really is, because maybe they think, well, I missed a payment on something, so my FICO is now going to be so bad. No. You really, again, it goes back to, we don't know what we don't know. So that's why it's so important to make sure to sit down with somebody, see what you can qualify for, because FHA, great loan, but we have some better options out here for you too.
So we want to dig into those. That's the meat of what we're talking about today. Before we do, can you just quickly, let's cover at least the time to save here. How long does it take to save 3%, 5%, 20%?
Wow. And I know, looking back, I have to say, I have to tag back to the postings that everybody was putting out there when you asked the question, Sean, about what do people think? How much money do people think they have to put down? I was really surprised at so many are still thinking they have to have that whole 20%, all these thousands and thousands of dollars. And okay, and I'm sure they're thinking, oh my God, how long is it going to take me to save that 20,000 or that 20% down, right? So our analytics group did did some research around all of that and kind of broke it out again by ethnicity as well. A lot of this too that you're going to find, depending on where in the country that you live, it's going to take longer because around the coasts, both East Coast and West Coast, they're more expensive, right? So that's going to take a whole lot longer time frame for you to save that money. For example, if you're looking at 20% down, and if you're out in California, it could take you almost 25 years if you're a Hispanic, because a lot on the either Hispanics or Asians tend to be more concentrated in the high cost areas around the coasts. And 25 years, do you really want to wait that long to buy a house? Oh Lord, right? And from there, as we move to the 5% and 3% down, it normally for white, non-Hispanic whites and African Americans, it takes a shorter time because those demographics tend to live more inland, away from those higher cost areas, just according to our studies. So if it could take you a little less time to have to save to get into that home, right? Isn't that an awesome thing? Knowing that you do have access to some of those products to be able to get in. But we may have be able to help subsidize some of that as well if you're able to tap into some down payment assistance to help you along that way.
Yeah, and another thing for you guys to think about is what's happening with the price of housing, what's happening with interest rates as you continue to save. We're not saying don't save. That's not at all what we're saying. We're saying here's what you can plan on. It's going to take you about this many years to save this much down payment. But as you do, home prices are going up. Interest rates may start to rise. Your rent, while you try to save, may be going up, and your income may as well, and that's good. But we want to look at all the options that are on the table as you plan for, the duration over which you need to save your money. So here are some things that you may be thinking about, Sandra, if you want to pick one or two, and then we really want to get into the products that Freddie Mac offers. But Sandra, what are our audience potentially thinking about as they explore homeownership?
Absolutely. So yeah, for you as a consumer, as you're thinking about, okay, writing that checklist, what are some things I do need that I either want in a home or that I really do need to be concerned about? First of all, what kind of home are you looking for? Are you looking for a condo? Are you looking for a home that already has energy efficiency built in? Are you looking for a manufactured home? Are you looking for a 1-unit property, or are you looking for a 2 to 4 unit property? And that's one where I know we really want to kind of dive in a little bit here for you, because we do know that one of the best ways to help build wealth is home ownership, right? And with home ownership, just think about it for a moment. Let's just say you decide, you know what? Maybe I should buy a 2-unit property, because that's a good start in that path to building wealth, because I'm living in one side and the other unit I'm renting out. And maybe you've got enough rent coming in from that piece to help even cover that mortgage payment and start you down that path of building wealth, right?
Yeah, and I want to touch on fixed versus ARM at the bottom right. Yeah. If if you're looking for a mortgage right now, just so you know, an ARM, adjustable rate mortgage, that is a mortgage that does not have a fixed rate for the life of the loan. That is a mortgage that has a rate that will adjust at certain intervals. And not every adjustable rate mortgage is the same. But we would encourage you to look at fixed rate mortgages where the interest rate never changes. And if somebody is trying to sell you an ARM when interest rates are at historic lows and can basically only go up, you should question it, and you should at least try to understand, how is that possibly the best option for me right now? So Sandra, listen again. This is really the meat of what we came for today. We've mentioned Home Possible and Home One. There's also this HFA Advantage product. Let's start with Home Possible and just let's drill down into the details. How is this beneficial? What are the nuances that make this a best or better option for a first-time home buyer?
Awesome, awesome. Well, Home Possible is either for that first-time home buyer, or you don't have to be a first-time home buyer necessarily either on Home Possible. But it is for those clients, those borrowers that make 80% or less of area median income. Okay, we do subsidize it, so that way it's going to be cheaper for you when you're meeting with your loan officer to talk to as well. You can get in as low as 3% down for 1-unit property. If you're looking at a 2, 3, or 4-unit property, you can get in for as little as 5% down. And again, using those flexible sources of down payment funds for either down payment and closing costs. And that's huge. That is huge. We don't require that any of your own personal funds go into the transaction. So it could either all be gifted, it could all be an affordable second, meaning those grants from like a local municipality. Could be if your employer is providing down payment assistance, it could all come from that. Again, it's such a great option. That private mortgage insurance that Sean was talking about, some of you might be thinking, what is this private mortgage insurance anyway? I mean, is that about me? Actually, no, that's for it's really to cover the mortgage company, just in the case that you may have life issues and may not be able to make your payments, right? It's really to cover the lender. But it's on those mortgages, whether or not it's the FHA mortgage or conventional. But the difference is when you've got it on this conventional mortgage, it can be canceled once you've got enough equity built into the property, right? Into that home. FHA, guess how long it stays on there? Forever. So just think that you're paying into into FHA, it's being deleted on the conventional once you've got enough equity built in there, which is going to give you maybe another $100 or more back in your pocket once that comes off.
That's every month, right?
I'm sorry, what? I'm sorry, Sean, go ahead.
And that's $100 or so every month that comes out of your payment.
Absolutely.
So one point of clarification, just for those that may not know where the data comes from or what exactly it means. When we say area median income, so this Home Possible program works for anybody up to 80% of that area median income. Can you just give us a simple definition for what the area median income is?
Absolutely. So the area median income is actually coming from our regulator. And what they do is they assess the income levels within census tracts, every census tract within the country, right? So, and within that, they assess all of the incomes within each area, and then kind of whatever the median within that is, they'll determine the 100% of that level. And then 80% is what we are looking at. So really our regulators are the ones that are determining that amount.
But it's based on the median or average income in that market, right?
Correct.
Yeah.
Yes.
So it's going to be higher in Los Angeles than it is in, Ohio.
In Atlanta or Ohio. Absolutely.
Okay. So Home Possible, you don't have to be a first-time home buyer. Does have income limits, down payments as low as 3%. Private mortgage insurance is dropped once you get to 20% equity in your home. Now let's compare that to Home One. Tell us more about Home One and how that works.
Absolutely. So you may be thinking, well, once I find out what the income is limit in the area that I'm trying to buy, maybe you make more than that 80% of area median income. That's where Home One comes into play, because it's going to look and feel just like our Home Possible mortgage, with the exception there is no income restriction. Okay. You can get in with as little as 3% down. Again, with those flexible sources of funds that we discussed for Home Possible, you're able to apply all of that to Home One as well. Fixed rate option only, just like with Home Possible, all borrowers do have to, you do have to occupy the property, okay? But other than that, I'm sorry, one thing to additional add with Home One, at least one borrower does have to be a first-time home buyer, okay? Which that's not a restriction under Home Possible. That's only for Home One. But again, there's no income, no geographic limitation.
Okay. So let's then compare that to HFA Advantage, and then I want to talk about how our audience can find out about these products. What, who do they go to? What do they ask? What do they say? But let's talk about HFA Advantage, this third option first.
Awesome. Well, that is our third 3% down program. And people laugh at me when I say this, but I always call it, this is our supersized 97 product because again, you can get in with as little as 3% down. It is a 1-unit property. Borrowers have to occupy still the same. It's that same look and feel as Home Possible. Here's one of the big differences here is for that private mortgage insurance that we were talking about. It really is half the cost of what it would be for like the Home One, and a significant reduction from what it is under Home Possible. It does have income limits, but that's where the local agency would set those limits. And it could be higher than what ours are set. So it could really vary depending on which HFA, because we do partner with HFAs, both state and local HFAs all across the country.
Yeah, no, we've talked about FHA mortgages, and now we're talking about HFAs, which are housing finance agencies. I just want to be clear, every state has their own state housing finance agency. They offer products like HFA Advantage here, along with down payment assistance. And there are many markets around the country where there is a local housing finance agency. They're not a lender themselves, but they work with Freddie Mac to bring products to buyers in that market. And they work with lenders who participate in their programs and products that actually originate for you guys. So you're going to the lender, which begs the question I wanted to ask here, Sandra. We're talking about Freddie Mac's Home Possible, Home One, HFA Advantage, and the answer may be different here depending on the product, but how does our audience inquire about these products? Who do they do that with? What do they ask?
Okay, if they're sitting down with their lender, or when they're ready to sit down with their lender, they can always just ask them outright, I would like to be considered or look at the Home Possible or Home One. It's in our seller servicer guide for any of our lender partners to utilize. So it's open for everyone to be able to use. When it comes to HFA Advantage, what I would do as a consumer, depending on your market, and let's just use Ohio since you put Ohio out there. Ohio is, the agency is called OHFA, Ohio Housing Finance Agency. So you could go to their website and they have a list of all of the lenders that utilize their products. That's how you would find those. So depending on what state you're in, you can identify, you can Google housing finance agencies and identify the particular agencies within your state, and then you could go to their website to find out who is offering it.
Okay, good deal. Sorry, I just got distracted. There's a deer in my front yard.
A deer? Oh my goodness.
Anyway, sorry, random, but
they want to know about home too.
Yeah. So, okay, so we talked about your 3 core products. I also want to mention that all of these, right, Sandra, can be used along with approved down payment assistance programs. But can you offer a little clarity around that?
Absolutely. So you can absolutely use any of the down payment resources that are available, and maybe you find 2 or 3 that you qualify for and you can use them. And that is awesome, because if you do, you can layer those. You can, if you qualify for all 3, you can use all 3. layer it as long as they don't exceed the certain total loan to value to be able to get into that home. And it's great. And you would have to go through a qualifying process because typically a lot of the down payment assistance programs may have a qualification piece that you have to go through as well. But your lender can help you with that.
Okay. So let's talk about some of the benefits for our audience of these programs. Walk us through, obviously we talked about low down payment and using down payment assistance programs, but walk us through some of the other benefits of using these particular products.
Absolutely. So the benefits, like I said, you can get in with as little as 3% down with none of that having to come from your own personal funds, right? Again, being able to utilize all of this down payment assistance that we've talked about, the gifts or grants, et cetera, to be able to get into that property. Now, if you are buying, I do want to put a clarifier here. If you are purchasing a 2, 3, or 4 unit property, you do have to have 3% of your own funds into it. Outside of that, you don't have to have any of your own funds. Again, the flexible sources of those funds to be able to get in, the mortgage insurance that we talked about, that private mortgage insurance, it can be canceled, after you have built up enough equity. And when I say built up, that's at 80%. You can call your servicer if you think your house is appreciated enough, and that way they can talk to your servicer and they can look at having that canceled. The other piece is all 3 of the programs do require the home buyer education component. We do have a tutorial on our website that meets the requirements for both Home Possible and Home One. Great tutorial, and we'll show you in a few minutes, just a couple slides where you can find that. And best of all, it is free for you to be able to utilize, and it's an excellent resource for you to be able to utilize. HFA also, the HFA Advantage program also has a home buyer education component. But they really are going to have their own requirements around that.
Okay. Yeah, and I'll point out too, guys, if you can use a down payment assistance program or flexible sources of funds for down payment using a low down payment mortgage like the 3 that you're seeing here, Home Possible, Home One, HFA Advantage, think about the impact that has on your liquid savings when you move into a house as well. So you're not spending every last penny that you have to get into the house, and then suddenly you need a lawnmower, you need blinds, whatever it is. So we want to point out all the benefits that we can here. So let's
exactly. Hang on. Can I add one more point there too, because it just kicked another brain cell here to chat real quick about talking about that down payment assistance. What if you were able to find quite a bit of down payment assistance to get in, right? Well, there's a way to be able to get in, like for that private mortgage insurance. And what if you were able to find a large enough amount of that down payment assistance, maybe to pay all of that up front? So if you're paying all of that up front for that private mortgage insurance that Sean and I are talking about, you're kind of effectively getting rid of that already. So it's freeing up that much more money in a monthly payment for you. In a house payment.
Well, and that sparked another thought from me, which is the more down payment you have, the lower your loan to value. So the bigger the gap between the price of your home and the loan that you get, the mortgage, the lower your cost of mortgage insurance on a conventional loan, right? Which is not the case with FHA. It just is what it is, regardless of LTV, for the most part. So anyway, all right. So let's move on. So let's talk about Freddie Mac's Borrower Help Centers and National Network. Now, for our audience, we've talked a lot in the past through the last few sessions in this series about counseling. Freddie Mac offers a lot of resources in this regard too. And I don't know if this is where we want to bring in Maheen, who's also behind the scenes here from Freddie Mac. But we got a couple minutes left here to talk about Borrower Help Centers and Credit Smart. So Sandra, Maheen, take it away.
All right, I can start it, and definitely Maheen, feel free, turn on your camera and join me in this conversation, join us in this conversation as well. So we do have partnerships across the country, a network of HUD-approved housing counseling agencies, which within Freddie Mac, these are all known as our borrower help centers. And we work with lenders all across the country in minority and underserved communities, 14 physical locations across the country, as well as we have a 15th network that's kind of where you're able to call into them to be able to ask for information around the home buying process. They're doing the virtual counseling, etc. these days too. But they were doing that prior to COVID, but it's just an added benefit as well. So within those 14 markets, if one you're trying to reach out to, you're not able to find, you can always utilize that 15th call line. And you can find all of those at the link below. But there's a lot of information that they can certainly help you with through this whole home buying process. So for those of you that are just starting out, highly recommend that you reach out to these folks for any assistance, any questions that you may have in this space. Maheen, do you have anything that you would like to add or any color around this before we move to the next slide?
Thanks, Sandra. I mean, I think this is great. It's absolutely a resource for you. And if for any reason you want to look up a HUD-approved housing counseling agency in your geography and you don't happen to be in one of these markets, then we can also share a link. I like looking it up from the Consumer Financial Protection Bureau's website, the CFPB, because you can do a search by zip code. But like Sandra said, even if you want to speak telephonically to a housing counseling agency, we do have a partnership with our Borrower Help Network. They're based in Florida, but they do serve the country nationally. So this is a great resource. Housing counseling, financial counseling, if you want to work on your budget. And also some people have questions about credit counseling and debt management. And there are some organizations that tend to specialize more in that arena. Again, In Charge Debt Solutions is our borrower help network. They do both housing counseling and debt and financial and credit counseling. But I'm also going to share another link in the chat, which you can look up the National Foundation for Credit Counseling. They're a great resource, and find a counseling agency if you're looking more for credit and debt related help.
Awesome. Thank you for that, lady. And don't go too far away because you're up in just a couple slides and just right after this. So
okay.
Here's another resource for you guys as well, which is My Home. So My Home is a consumer resource center for all of you guys to be able to utilize. Again, because the home buying process can be a little intimidating, even for those of us that have purchased a home. It still is. So this is some information that's available for you, tons and tons of information where you can tap into and do that research to help kind of ease the pain a little bit. And speaking of kind of easing the pain, our next two slides really are talking about our Credit Smart curriculum. And with this, I really want to, our tutorial as well as our standalone modules. So I'm going to turn this over to Maheen to talk through these. Maheen?
Thanks, Sandra. Sounds good. So we do have Credit Smart Homebuyer U. It is a comprehensive, unbiased homeownership education course. It's online and it's self-paced. You can use it on your mobile, your laptop, whatever you want. You can switch devices, do it at 2 o'clock in the morning or 2 o'clock in the afternoon, whatever works for you. And whether you are on your way to get a conventional mortgage or you're exploring and you're looking at different kinds of products, it gets into the nuts and bolts of the home buying process, credit, money management, the 4 C's of lending, as well as how to get a mortgage, getting a home, and preserving homeownership, which is really important as well. Of course, that's really top of mind right now for people being in the crisis environment, is to have sustainable homeownership. So again, this link to Credit Smart Homebuyer U is a good resource for you. It's free. I know there are other really great homeownership education courses out there as well. such as eHome America framework, and also, again, back to HUD-approved housing counseling agencies. They tend to offer homebuyer education as well. I would suggest making the most of these opportunities, because once you're educated, you will feel more empowered going into the home buying process.
And Maheen, if someone, when they take this, the tutorial that's here, how they get a certificate, right?
That is very true. So anybody can use Credit Smart Homebuyer U, but you will get a certificate. There's a 10-question quiz. You can take it as many times as you need to pass it. There's an 80% or higher score for passing it. And that certificate can be shared with your lender, like a loan officer, with any kind of real estate professional, or your co-borrower. It's really easy to print it, email it, and things like that. And as Sandra mentioned earlier, if you do end up with a Home Possible or Home One loan, one of the Freddie Mac low down payment products, our certificate for Credit Smart Homebuyer U does meet our home ownership education requirement.
So two things, Maheen. You got to it, but I think maybe you glossed over it. And I think maybe our audience, probably their top question, what does it cost for Credit Smart?
Okay, Credit Smart is free, completely free. So we recognize that education is a really important thing in this space. It's a complex space, the mortgage and financial capability space. And so Freddie Mac has made all the Credit Smart resources free.
Okay. Yeah, and I just want to point out for our audience, if you went and don't buy a car right now, if you're thinking about home ownership, get the home first. But you wouldn't go buy the first car that a salesman showed you, and you wouldn't just take the rate and the price they gave you, right? Home ownership is even more complicated. Get yourself educated, take advantage of all these resources. Freddie Mac puts this out there for free, and you're going to go into the transaction and start building your team as a better educated consumer, and you're going to get a better deal for that. All right, so Maheen, let's wrap it up here with Credit Smart Financial Education, and then we'll get into Q&A.
Sounds good. I'm actually going to gloss over this one. This is just one of the other resources we have in the Credit Smart quote unquote suite of financial education and homeownership education resources. Again, there is a link here. This is more about money management, deeper information on credit. This is not so much a homeownership education course. However, for anyone who's serious about home buying, Credit Smart Homebuyer U is probably your best resource in the Credit Smart suite.
And I would like to add one thing while we're talking here, Maheen. This 12 module series, this one is actually available in other languages too, right?
That's correct. Yes, we have it in Spanish. We've got Chinese, Korean, and Vietnamese as well. This information is online, and it can be downloaded and printed or perused on your device that you prefer to use.
Perfect. Thank you, ma'am.
Sure.
Okay, so let's wrap this up with some final takeaways. And I've seen a lot of questions for our audience. Fire away, because we're all sticking around here to answer your questions. And we'll go over some of the ones that have been answered in the background as well. So I'll throw a few out there, and then Sandra, Maheen, if you want to chime in. But from our perspective, we would say try Credit Smart. It's free, right? So take advantage of the opportunity to self-educate and better prepare yourself for this homeownership journey, so that you are more confident and more ready for these conversations when you speak with a counselor, when you speak with a loan officer, when you go through your homebuyer education course, when you're talking about down payment assistance, or when you're working with a realtor and looking at signing a contract on a home. The benefits permeate through all of those parts of this process. I would also add, research your mortgage options. There are a lot of options out there. In the process of educating yourself, you're going to learn more about them. But most importantly, understand down payment and mortgage insurance requirements and how they relate to your costs up front and how they relate to your costs long term as an owner. Sandra, Maheen, anything else you want to add as a final takeaway today?
I think you have wrapped it up pretty well. I think
you got it.
Yeah.
Okay. So let's do this. For all of our audience, of course, explore down payment assistance, but we've covered that. Next on our path to homeownership series will be the topic of homebuyer education. We've talked about it here. We've talked about it in most of our previous webinars in this series. Homebuyer education or completion of a homebuyer education course is typically required to access down payment assistance. What we talked about today were first mortgage products from Freddie Mac, and I've seen some of the questions. I think we're going to end up back on that slide with your products on it, and I might go there for a moment here. We will also continue on with the role of the real estate agent, and then, as mentioned again today, there are implications for you as an owner. There are things you need to know post-closing. What's going to happen? Who does my first mortgage payment go to? And we'll get into all that in the sixth part of this series. I want to put this up here while we get into Q&A, and I want to queue up Melinda and Fern and Tamara and Veronica, who are with our down payment resource team, to see if they're seeing any trends, any questions that have been coming from multiple people that we need to address. And then I suspect we'll probably end up back on the product slide because of some of the questions I saw. But Fern, what do you got? Any trends, anything we need to address?
Sorry, I was just actually in the middle of but a good one that over, I'm just going to read this. If a program gives $1,000 in down payment assistance and $2,500 in closing cost assistance, is that better than $10,000 down payment assistance and a $7,500 closing cost assistance? So the question really is the higher of down payment versus closing costs, or do I? So could you just talk a little bit about that?
I'm not sure I caught enough of that. Fern, you're having some audio issues. I'm trying to find this in the Q&A, or Mel, if you can find it or know where it is.
Sean, the question, the question was basically if you have $15,000 in down payment, as opposed, I can't remember the exact number, as opposed to say $5,000 in closing costs, right? So you have closing costs of $5,000, $15,000 down payment. Is that better than having $10,000 in down payment and $7,500 for closing costs?
I see. I'll give you an answer, and Sandra may have one too. Talk to your loan officer. There are going to be thresholds. If you get a certain loan to value, if you can get 3% down, you can get a good deal. If you can get 5% down, you can get a better deal. And the more down payment you put, the lower your mortgage insurance, the lower your monthly payment, but you will still have closing costs. Now, sometimes the seller will cover closing costs. There are a lot of ways, and you could make more competitive bids on a property if you don't need the seller to cover closing costs. So there are things like that you need to weigh. But Sandra, what kind of answer would you provide?
And I totally agree with that. The other piece that you do have to think about is depending on who is paying those closing costs, because if it is a seller paid closing cost, there is a limitation within the conventional space, especially if you're talking about those loans that are greater than 90%, because it's only allowed at 3%, right? It cannot exceed that. So that's something that you need to be cognizant of. And that's, to Sean's point, making sure that you're talking with your loan officer, because they'll point that out to you as well.
And the what Ivan was, I just found it. What he was asking specifically is if the program gives you this much for down payment or this much for closing costs, is it better than a program that does this or that? And I think a lot of that, like you guys said, a lot of it depends on how much are your closing costs going to be, right? So if you have a program that only allows you to use certain funds for closing costs, then and if the closing costs aren't this much, then you can't use the rest of it for down payment. You have to kind of weigh your options. Or do you need more down payment so that your monthly payment is less? So it just definitely is going to really depend on your personal situation.
Yeah, agreed. And work that out with your loan officer, because there are too many things you need to explore. The cost of mortgage insurance, the right product. You know, which product are you even trying to obtain? I know we got a lot of other questions, though. I'm actually gonna go back to this slide here. I've seen a lot of questions about these programs in particular. I just saw one. Sandra, how long do you have to live in the home if you use one of these products?
One of the programs or one of these products, we don't have a cap on how long you have to live in it.
Okay. Tamara, Mel, Fern, are you seeing any other questions about Freddie Mac's products in particular? And Sandra, I saw one earlier. We've thrown a lot at our audience today, and we did it fast, and we've used a lot of terms maybe we are used to using. Guys, if you have any questions about these specific mortgage products, I mean, this was really the crux of the webinar today, was to show you what conventional mortgages can look like for you and some of the benefits. But fire away if you have any questions in that regard. Or Mel, Tamara, did you see anything we can address right now?
No, I just want to clarify a point you guys just made. While there's no specific term you have to stay in a house for these programs, keep in mind if you're going to put DPA, down payment assistance, onto these programs, majority of DPA programs do require you to be in the home for either the life of the loan or a specific amount of time.
You are absolutely correct. And Tamara, thank you for that. I was actually about to add on to that because that's absolutely true. And to Tamara's point, it really depends on what type of DPA, because some of them, they may say 5 years, 7 years, 3 years, 10 years, or life. And if you try to sell it prior to that time frame that's on there, they would ask for a repayment of a certain amount of that. Like if it just says that you have to live in the property for 5 years and you sell it in 3, then you may have to pay back that 2 years worth in there, if that makes sense.
Yeah, and every down payment program is different. We provide all that information through Down Payment Resource, but I do want to focus on some of these Freddie Mac questions here. So Jim asked, for some of the products you mentioned, which we now have back on the screen here, what are the typical credit score requirements, and do they vary among these 3 programs?
They could, but for us, we just ask that our lender partners run everything through our automated underwriting system. And we really aren't looking at a FICO. We're looking at the total risk of the borrower, right? So when it's run through our automated underwriting system, that's all that we're looking at. Now, because it's going to look at the income, it's going to look at the property, it's going to look at your credit, it's going to look at you as a whole, not just as your FICO is X. So
there's not a minimum per se. It's really just a kind of a holistic perspective, looking at the transaction in the household and so forth. Correct. Okay, so Richard asks, and now this is sort of broad, but let's give it a try. Richard asks, which is the better option? So, do you have an answer, or are there reasons why one might be better than the other in certain circumstances? If income, because income is capped on like the HFA Advantage and Home Possible. Between all of that, HFA Advantage, like I said, that is our supersized product, because Freddie Mac subsidizes part of this for our lender partners. So a lot of fees that would normally be assessed to a lender for some products that we offer, none of those are assessed on the HFA Advantage program. Plus, that mortgage insurance is like half the cost that it is for a standard conventional. So if you can qualify for the HFA Advantage, that would be the number one. Okay. In my humble opinion. Let's see. Melinda, Fern, Tamara, Veronica, what are you guys seeing? Or what have you answered maybe early on that we need to touch on that was important or that you saw multiple times?
There's another question right now in the chat asking if you can review the MI information that you discussed and how that can save some money, if you don't mind going over that again.
Sure. So MI requirements related to these mortgage products?
Yes.
Okay.
Can you discuss again about the MI cap and the result of more money saved each month?
Yeah, go ahead, Sandra.
Okay, so mortgage insurance, and let's just compare conventional to FHA, because if you're doing an FHA, you've got all of this upfront that Sean had talked about earlier in the presentation, that is financed in, building, and you're already eating into the equity, and then a monthly payment that's on there forever and ever. Amen. For the conventional product, it is nothing up front. It is a monthly amount that's added in, but it can be eliminated once you have built up enough equity into that home. So if you're looking at it on paper, you may see, well, FHA is a little less than what Home Possible is, but don't be focused on the right now. Look at the long term, because in the long term, that for the conventional, that private mortgage insurance is going to be eliminated, right? Which again, it could free up over $100 a month in your monthly payment in a relatively maybe 4 or 5 years period of time. Where FHA, it's on there forever. Okay, does that help?
Hey, Sandra, there's a question here. I just lost it because stuff keeps scrolling up. Can each of these programs, the ones that we're looking at now, each of these programs be used for a duplex property?
Only Home Possible can.
I've seen several questions. Oh, go ahead, Tamara. Sorry.
What about multi-home, multi-family?
If you're saying a multi, like for us, so Maheen and I are in the single family division. So with single family, that's a 1, 2, 3, or 4 unit property. Anything greater than that, that would be considered multifamily, 5 units or more. Those would not be eligible to be used for any of these 3 products.
Thank you. And thank you for clarifying multifamily.
Certainly.
So I've seen several questions about profession. I'm reading one that got answered earlier. A teacher was worried she didn't have a lot of savings. Her income might be higher than allowed on some programs. She was in a high cost market. I saw another one earlier. Somebody was concerned that his profession locked him out of down payment assistance programs. I want to clarify, if you work in certain professions like first responders, educators, if you've got a military background, if you're in medical field, there may be additional down payment assistance programs for you. But you, just as the general public, can still qualify for all of the other down payment programs that are still out there, subject to income limits, credit requirements, and so forth. So if you're a teacher and there's no teacher down payment program in your market, that doesn't mean there's no down payment assistance for you. It just means that as a teacher, you go to the other down payment programs like anyone else and see if you qualify. So I wanted to address that. I saw a few questions related to profession and down payment.
So Sean, let me ask you a quick question about that down payment assistance. So do you have to be a first-time home buyer to access that down payment assistance?
No, and that's a myth we cover all the time. We're a couple of days away from publishing a report that clarifies that, but no, more than a third of the programs for down payment help across the country don't even have a first-time home buyer requirement, and more will waive that requirement if you work in certain professions, you have a military background, or you're buying in a targeted area. So there are plenty of opportunities out there for down payment help, even if you currently or recently owned. I'll also add, because we've got a first-time homebuyer requirement up on the screen. Sandra, tell me if your definition matches, but you're a first-time homebuyer if you haven't owned in the last 3 years. If you owned 5 years ago and sold the house, you're a first-time homebuyer.
Yep, exactly.
Let's see. Somebody asked if we can talk about lender overlays. That's kind of up to the lender, but Sandra, anything you want to add quickly there?
That's pretty much it. I mean, what's in our guide is accessible to all, but some lenders do have certain things that they want to add on that. Absolutely.
Which could be, a higher minimum FICO. It could be they won't do certain property types. It's really up to the lender.
Yep.
Let's see. Does dental assistant qualify as medical? Annie, potentially. It depends if there's a program for medical professions in your area. But again, don't stop looking for DPA because of your profession, because guess what a dental assistant qualifies for, or a dental assistant? Everything else, right? All the other DPAs, all these Freddie Mac products.
Yep.
Profession does not preclude you from qualifying for a DPA or mortgage products. There just may be additional opportunities based on some professions. Let's see.
I've got one here. Sandra, all of this information, does this apply to new construction homes that won't be finished until February 2021?
Well, they would have to close in 2021, but yes, these can be applied if it's a new construction, yes. Now, it can't be the construction loan that's being done. It's just we would be financing the end loan, if that makes sense.
Yeah, that makes sense. And just keep in mind, folks, if you add DPA onto one of these, that also can change the answer.
Mm-hmm.
Let's see. Teresa had a question. What is the difference between fee simple and quick sale? I'm not sure that's an apples to apples comparison. So Teresa, fee simple, the opposite of that would be leasehold. Quick sale is a different kind of thing. It's more of a different kind of transaction. I don't know, Teresa, maybe clarify your question if you can. I'm not quite sure we understood that.
Hey, Sean, there's can you hear me? Okay.
Yeah.
Okay, so the question is, I heard decreased. Does this mean that down payment requirements will also be lower?
Well, the simple answer is down payment requirements and interest rates are not related. So essentially, no. Yeah, but Nicole, I think, is the one that asked that question. Yeah, mortgage rates, I mean, we've been saying for a while they couldn't get lower, and they just keep going lower. But at some point, there's a floor to this, and we must be there now. But in all of the history of, at least the sort of formal housing market in this country, we've never seen rates this low. So this is literally the best possible time to be trying to buy a home and get a long-term fixed interest rate that will sustain the life of your mortgage. As for down payment requirements, that depends on your mortgage product, and you've also got access to down payment assistance and other flexible sources of down payment funding.
Right. I got to say, last night, as I was kind of prepping for today, our company actually does a national survey weekly all around the country to determine what is the average interest rate right now. Yesterday's, we posted 2.9 as the weekly average for a 30-year fixed rate mortgage. That's pretty awesome.
Yeah.
Yes.
So here's a good one. And Sandra, I'll ask this of you. If you're in a current payment plan for federal and or state taxes, so I'm guessing there's some back due taxes, they're on a payment plan, or maybe not back due, but maybe they're just on a payment plan to pay a past tax bill. Would that preclude you from mortgage approval?
Likely, yes, because a federal tax lien, if it ended up in that space, could take first lien position over us. So that one would be required to be paid.
And what if it wasn't back taxes owed? What if they're just on a payment plan to pay the last tax bill? Is that, I don't know, is there still a lien there?
Yeah, if there's no lien issue, that shouldn't be a problem. But that one, I'd like to do a takeaway on that, maybe, and get back.
Okay.
For most mortgage approval on that, as being a previous lender, if you do have an actual payment plan, a lot of times then the lender will take that payment and just add it to your DTI, confirming that you are current on your payments. But it would have to be something that you actually have a plan in place. And a lot of times they want to see at least 2 payments made before they're willing to add it to the DTI. But yeah, it depends on the situation.
We got some clarity here on that fee simple question. So I'm going to throw this back out there again. So Teresa's asking, she's been looking at some properties and she sees some that say fee simple, but she also sees some that said they were for quick sale and were connected to foreclosures. So I'll offer a little bit of clarity here. We're still comparing apples and oranges. Fee simple means you own the land and the property when you buy it. The opposite of that would be leasehold, where you actually don't own the land under the property. that's, I mean, it's not uncommon. It's not as common, certainly, as fee simple in most parts of the country. Usually you're going to be buying a fee simple property unless you're on a land trust or native lands or something like that. Now, separate from that, as part of the foreclosure process, there are different ways that that transaction can happen. If you are looking at foreclosed properties, the process may be a little different. You may have to go about your mortgage qualification a little faster. Sandra, anything you want to offer on the foreclosure piece of that, quick sale? Things like that?
Yeah, absolutely. If I'm wondering if they are actually talking about either like a deed in lieu, trying to purchase that, or a pre-foreclosure sale, like a short sale, trying to get that before it actually goes into the foreclosure process. And for that, it's just a matter of, it's still going to be titled the same as a fee simple or whatever. It's just, they're just trying to sell the home quicker to help this borrower avoid a foreclosure situation, if I'm understanding this correctly.
Yeah, so Teresa, I hope that helps. I don't think the fee simple piece is related to what you're exploring here, which is purchasing a foreclosed or pre-foreclosure property.
Yeah.
Let's see. Anthony asks, do you recommend using 401k savings for down payment? I'm going to go with a hard no, and I'm going to back that up. So when you do that, you are borrowing money now, and you are taking the future value of that money away from yourself, when there are potentially many other ways to come up with that down payment, including down payment assistance programs. Anthony, there are a lot of ways, there are a lot of down payment assistance programs that can be flexible on income limits, on purchase price limits. I don't know what and don't tell us, we're not asking, I don't know what your balance is in your 401k, but the thing about a 401k is compound interest and future value and time value of money. Don't take away from that now. Explore other options.
Exactly.
Don't borrow from your future self to get into a home when there are other options to get you into a home now without detracting from the value of retirement assets. But anyway, Sandra, anything else to add?
No, I total 100% agree with you.
Okay. Is there a difference in down payment and closing cost assistance? Yes, down payment helps you cover the down payment on the home. When you go through a mortgage transaction, there are closing costs that you must pay to the title company, to the loan officer, to the processor. Those are closing costs. Some programs may allow you to cover both. Some programs might just be for closing costs or down payment. Each program is different. And then, of course, you have mortgage products like the ones that we're still looking at on the screen that may have different guidelines. But the closing costs come essentially from the lender and the transaction. The down payment is how much money you put down on the home, how much equity you have in the home at closing. Let's see. I don't know, Mel, Fern, anything else here?
I've got one here. These programs are here, Sandra, these three, not for second homes?
That is correct.
Okay, so it has to be primary residence.
Yes.
Thank you.
There's a question about, I'm sorry.
Go ahead, Fern.
I was just going to say, layering just came over. Can you use more than one DPA?
Yeah, you can. That's certainly possible. Depends on the program. Not all of them can be combined. But Sandra, I'll let you speak to whether or not that's possible with these mortgage programs as well.
Absolutely, they can be. And depending on if it's considered our definition of like an affordable second, they can go up to a 105 total loan to value. So as long as you're not exceeding that, you're good. You're good.
And let's clarify what that means too. Total loan to value. So 100% loan to value would be the purchase price, a loan amount at the purchase price. But explain total loan to value.
Right. So total loan to value would be, so they put 3% down. So that would take you to a 97, right? So a total loan to value would be if you're adding any subordinate financing to it, like an affordable second. That would be a subordinate to our first on the home possible. So it'd be that plus the balance of that affordable second being added together to combine that against the appraised value of the property to come up again with no more than 105 for a total combined loan to value.
Meaning,
I said that.
essentially, yeah, meaning you could finance more than the actual purchase price.
Yes. Yes.
And help cover closing costs, down payment, and so forth.
Yes.
So that I suspected was going to prompt some more questions, and it did. So Tasha asks, what is the difference between a first mortgage and a second mortgage? And in what case would a lender ask for a second mortgage? I'll start. So a first mortgage that's the money you use to purchase the home. A second mortgage or subordinate loan is essentially down payment assistance, usually. Your lender's not necessarily going to ask you for a second mortgage. They're going to offer you the opportunity by way of a down payment assistance program, which would be a second mortgage or second lien behind the home possible or the first mortgage that buys most of the value of the house. Sandra, anything else to add?
Nope. You got it. You got it. Mm-hmm.
Okay. So, and Tasha, I guess I'll add to that. It's more likely you're the one asking your lender for those opportunities. Your lender may not ask you, hey, do you have a second mortgage? If you go to our website and look for down payment programs, bring that up in conversation, but be aware of your opportunities for down payment help when you go talk to a loan officer and say, hey, by the way, I heard about this down payment program. Let's get the mortgage lined up and then let's look at this down payment option. Fauna asks, is 100% financing a viable option? We talked early on about USDA if you're buying a rural property. We talked about VA loans if you're a veteran. Those are viable options. But what about conventional financing, Sandra?
No, we do require at least some down payment in there, which is our 3%.
Now, the net result with a down payment assistance program on top of that, though, could be that you cover 100% of the loan. Correct.
Mm-hmm.
Angela asks, is it best to have a total of 20% down with the DPA? And again, I'm just looking at the DPA part, but if you can get to 20% down with the down payment assistance program, that's great. You may not be able to get that far typically, 3%, 5%, 8%, maybe 10. It depends on the down payment program and the cost of your home. But as far as the 20% down part, I think maybe we need to dispel a myth in there too. Do you have to have 20% down, and what are the benefits of 20% down?
Mm-hmm. So, yeah, do you have to? Absolutely not. Do you have to? If you do have that much money and be able to get in, well, it's automatically putting you in a better equity position because you don't have to have that private mortgage insurance included. That's one of the main benefits of that, and could take you into a better option as far as mortgage option as well within these, having your home possible, home one, or HFA Advantage. Better is not really the right word, but yeah.
Yeah, just different. So this 20% thing, for all of you that are wondering, the reason 20% down is a magic number, if you will, is because that's when on conventional mortgages, you get to drop mortgage insurance. It doesn't mean you have to have 20% down. So don't not go explore home ownership because you don't have 20% down. Please go talk to somebody and let's figure out how we can help you.
Exactly.
Let's see. How do points affect you when it comes to almost completing the process? Okay, points. I wonder if they mean discount points. Clarence, maybe offer some clarity there. How does points affect you when it comes to almost completing the process of home buying? I suspect that's about discount points, Clarence, but I need a little more clarity.
Sean, there's a question about if you pay off early, is there a penalty?
No, there is not. Not on any of our mortgages that are owned by Freddie Mac.
What about mortgage insurance? Can you pay that off at any time? That comes from Anthony.
Once it's on your mortgage, I don't think it's not paid off, but it can just be canceled once you have enough equity into it.
So you either handle it up front or
right.
you're with it till you get to 20% equity positions.
Correct.
Okay. Let's see. Angela asks, I qualify for 3%. Okay, Angela, I'm not sure that's a question. But that's great if you do, and go get locked, get a great interest rate, and then you start looking for a house. Angel asks, what if you own an inherited property? I guess
Okay.
I'm not sure what the actual question is. Angel, maybe clarify, what is it that you have a question about, unless Sandra, you have an idea there.
I have an idea. She's probably saying, well, I have this property and I want to buy another one. Can I still use one of these products? Meaning, so they're asking, because most of these are first time, you have to be a first time home buyer. So with Home Possible, you can own another property. So you could own the one plus the one that you're going to purchase if you're doing under Home Possible.
Okay.
Okay. Now for Home One, now we're talking about finance properties. So if you own that other property and it's free and clear, there's no liens, there's no nothing, I don't believe that counts. I will need to take that as a takeaway myself. Could we do a follow-up on that response? Because I honestly, it's still home ownership. You still own another property. So Home One and HFA, they may not allow that. With Home Possible, it does allow for it.
Okay. Let's see. Tasha asks, what is the average amount of money most people put down on an FHA loan? She gave a kind of a range here. I think it's actually, I mean, it's 3.5% or maybe slightly more. But what's the average people put down on conventional loans, or maybe for first-time home buyers?
On average, our statistics are showing that on average, it's around 10%.
It's
so,
around,
but go ahead. I'm sorry.
I missed the number there. It's around what percent?
It's around 10% on average, what they do put down. Do they have to do that? No, but that's around the average that is being put down.
Yeah, so half put down more, half put down less.
Yeah.
And I think we've covered down payment requirements pretty extensively here. Let's see.
Can we answer this one, Sandra? How typically, okay. It looks like Fern already answered this one. Never mind.
Okay, so I'm trying to follow Clarence's question. Tamara or Mel, can you follow that chain? I want to come back to Clarence. He's got a couple of comments in there, but
so Sean, there's one here. If you could help answer this one. A new construction project and required to use the builder's lender. A way to use a DP, that lender does not offer that.
So let me just repeat that back, because broke up a little bit there. So somebody is buying in a new construction project, meaning a developer's building a neighborhood, selling each home once it's done, and they're required to use the builder's lender. I would question that, first of all. They may recommend it. You are not required to use anyone's lender.
Correct.
I think we can all probably agree on that.
Yes.
Now, you may have incentives for doing so, and that's fine, but you're not required. However, those incentives can be pretty compelling. And is there a way to use a DPA program if that lender does not offer it? Yes, if you find a lender that offers it. No, if the lender that you're going with is not willing to offer it. I mean, I guess that's just kind of point blank the simple answer. But I think the bigger issue there is that somebody has convinced you are required to use that builder's lender. But Sandra, Fern, Tamara, anything else to add there?
Well, and that is sometimes a common practice when purchasing new construction is all builders have preferred lenders, right? That's who they send their loans through typically. So as Sean stated, while you are not required to use any specific lender to purchase a new build home, there can be some very large incentives. They might be giving away some stuff, upgrades, if you do use their lender. So, you need to weigh what you're getting with their lender in the house compared to what your savings could be if you go with a lender that does DPA.
Yeah. So, and to be clear, sorry, I forgot who asked that, but it's common practice. There's nothing wrong with your builder having a preferred lender partner. They do a lot of business. They're able to streamline things and offer incentives. You are not, however, required to do so. So if you wanted to explore down payment assistance, like Tamara said, maybe that's a better option. You will be slowing down the process. If you're under contract now, you're going to have to start over with another lender, but weigh all those things and figure out what's best for you. That's what we're here to tell you.
Yep.
Let's see. I don't know if somebody was following Clarence's stream here. I want to make sure we get back to him.
Clarence was talking about, I think we were talking about points, right? Well, then I see something where Clarence said, yes, penalty wise. So I don't know if that clarifies the points issue.
So let's see, started with, as an example, if I get approved for a home loan of 275, what percent down would amount to, I guess, the best down payment? I mean, 3% down, home possible, home one, you're in a great mortgage position, and
Yep.
low MI that goes away. So Clarence, I hope that helps. Let's see. So Tasha, more on the builder. Yeah, I think that's a typical incentive, $500 out of pocket, because they're going to offer some closing cost incentives and so forth. So yeah, that's pretty standard, Tasha. Let's see.
How about the one from Teresa? Do we know the amount of the PMI if you want to pay up front, or does it vary?
That really would vary depending on their FICO score. It
And
really,
loan value, right?
yeah, yep, exactly. And the product, absolutely.
Yeah. So, and there's a related question here from GB. Will the lender allow me to accept a higher interest rate in lieu of PMI? So lender paid PMI. Sandra, can you talk about that for a moment?
Yes, they absolutely can do that. And I know a lot of lenders do kind of price in that into the interest rate. So you would be able to have that 97 loan with no mortgage insurance. Yes.
And the trade-off there is you don't have the added monthly expense of mortgage insurance every month until you get to 20% equity.
Exactly.
But you absorb a slightly higher interest rate. You could still come out better. It just depends on other factors, but it's worth looking at.
Yep.
So GB, check that out, and I forget who the other person was. Let's see.
How about Jennifer's question? Tell us, Sandra, can you give us Freddie Mac's view on manufactured homes? Because Jennifer is wanting to acquire a lot and put a manufactured home on it. What is Freddie's take on manufactured homes?
We love it. And you can finance that using our Home Possible up to 95% for the manufactured housing. So we do allow that. And what would happen is once you have the lot and your manufactured home would have to be secured, put on a permanent foundation, taxed as real estate, that whole bit. And then you could do either a purchase or depending on how you do the lot and the manufactured home, this is where you really need to talk to your lender that you're dealing with, and they could help guide you through that whole process, whether or not it's treated as a purchase or a refinance. In all likelihood, it would be a refinance if you've already purchased the lot and now you're putting the manufactured housing on there. You're going to refinance to put it all into one, right? But we absolutely will do that up to a 95%.
I think part of her question too was about acquiring the lot, but the mortgage is on the structure, not the lot, right?
Right. It's on the whole piece, the lot and the home and the mobile home and the manufactured home. So when they do the whole piece, right,
Okay.
the whole refinance.
So she can acquire the lot with the structure and use
Correct.
Okay, so yeah, I think that.
And then we base it like on the acquisition cost or the appraised value, whichever is the lesser of those values.
Okay.
Mm-hmm.
Let's see, we got more flooding in here. So I think we'll go for a few more minutes here, guys. Keep your questions, or let's just maybe, we'll call it last call. Send your questions in, and we'll get through whatever gets typed in here in the next minute or so. let's see.
There's a question in the chat quickly. So the question is, my partner has the loan, but we are both on the title. Would I qualify as a home buyer?
Okay, so the partner has the loan. They're both on title. They're on title. That's what counts as ownership, right? It's not who's on the mortgage. It's who's on the title, ownership interest.
Right.
So yeah, Jillian, you are not a first-time home buyer if this is current. If you are, if you guys are in that home now and both on title now, then you're not first-time home buyers. That's not going to stop you from buying the next home, though, if that's what you're getting at. So maybe you're not a first-time home buyer, but keep at it.
Right. And you can still use Home Possible for that because you don't have to be a first-time home buyer.
Correct. And there may be down payment assistance programs as well, because not all of those require that you be a first-time home buyer. Okay, so there's Nikisha asked, there's a new home called modular. So she's talking about modular homes, kind of fit in that space between manufactured and site build or stick build. It has solar panels. Does Freddie Mac work with that type of home? Do you guys allow modular?
If it is considered a stick-built home, because we do have some modular homes are considered a stick-built home, and we will accept those. I think it just depends on that classification, if that makes sense.
Yeah, so Nikisha, you probably need a little more detail about that modular home, but my guess is you're good to go. Keep at it.
Yep.
Sean, drop to the one below from Victoria.
All right, if you're self-employed, can you bypass the 2-year requirement for loan approval if you have the required down payment from the business?
From the business is kind of throwing a monkey wrench in there.
Yeah, I think you're mixing apples and oranges there.
Yeah.
Either the business is buying an asset or the individual is buying a home. But Sandra, are we mixing things up there?
It kind of sounds like it. Sounds like.
So you need, when you're doing self-employment, they do want to see, a 2-year history of self-employment. But that is for you personally buying a home. And then if you're talking about the down payment coming from a business, that's a totally different aspect of it.
Yeah, and Victoria, that may be the extent to which you're going to get an answer out of us. We're all single family people. We're not business advisors or CPAs. I think there's some other people that you probably have in your network that you need to ask that question of. Let's see. Yeah, Nikisha built in a facility. Yeah, modular homes. Definitely familiar with that. I think you're probably good to go. Just talk to your loan officer, get a little more detail about those properties.
Yep.
Let's see.
Hey, Sean, there's an interesting question from Andrea. Can potential income from multi-unit property be considered as buyer's income when purchasing? So I'm guessing they're talking about renter's income.
At the time of purchase, right?
Yep.
Yeah, so Sandra, if you don't have a rental history and the first house you buy is a duplex, what happens with the income from the second unit?
Okay, see, this could be kind of a double-edged sword here because yes, you can use the income from it. However, when you're using that income, that also is going to go into the area median income qualification. So that may put you over the qualification, over that 80% of the area median income. If you can qualify for that 2-unit property without that rental income, you don't even have to include it in there, because all we're looking at when we're looking at income to qualify for our programs would be that income that they have stated and that we have verified that's on their application. Okay, those that are actually those borrowers that are on the note, not household income. Okay, so if you don't need that rental, you don't have to count it.
All right, couple that we'll fire through here, and then we'll get to an end here. So these are good. Nanette asks, I have debt on credit cards. Should I apply for a consolidation loan to pay off the debt and improve my credit utilization? Nanette, be careful with that, especially if you're looking at buying a home soon. when you start paying stuff off, especially if you start closing accounts, and that's different. Payoff is one thing. Closing the account and shutting it down is another. You may not improve your credit. So you need to talk to a housing counselor. I would suggest that before even a loan officer. But Sandra, anything to add?
Totally agree with that. Maheen had texted me. She had to drop because this is one thing that we talk about all the time, because people do have that misconception. Well, if I pay it off and close it, it's going to help my FICO go up. No, it won't necessarily. It could make it go down. So you definitely work on just paying it off yourself. I would not do the consolidation, but just work on taking care of the credit yourself, because as Sean said, it could impact it, and not in a positive way.
Yeah, and Jillian replied back, I think this was in regard to ownership with a partner. She's actually looking to buy out the partner, wanted to get some help with that. Yeah, I would talk to a loan officer, maybe an attorney. I think you're getting outside our area of expertise here with that scenario. But
Hey, Sean, I wanted to address one here just real quick. Sharenda asks, can you get down payment assistance if both spouses are not on the loan? The short answer to that is most programs don't require both spouses to be on the loan. However, number one, the non-borrowing spouse's income may still be counted towards the income limit. And number two, the non-borrowing spouse may not be able to take title if they're not on the loan, depending on the program.
And your state, there are certain states that treat those spousal transactions differently, right?
Absolutely.
Yeah, community property states, yeah.
All right, Tequila asked, what is a good FICO score? Do we have an answer? Is there really a right answer to that?
The higher, the better, because that is going to put you in a better position for different loan products as well. So,
yeah, I'd say in terms of down payment assistance, once you get up to about a 620, then you really start to open the doors for down payment assistance programs. But don't dismiss or delay mortgage qualification if you're not there yet. Again, talk to a counselor, talk to a loan officer, see what your options are.
MI is very FICO driven though. So if you're looking at mortgage insurance, like Sandra said, the higher the better, especially if you want to buy out that MI, you'll have much less to buy out if you have a higher FICO.
Okay. Let's see. We'll go maybe 2 or 3 more here. What FICO score do you need for a 3% down on a mortgage loan? So Sandra, you've kind of covered that. It's not that there's a threshold necessarily, but can we walk back through that real quick?
Right. Again, what we normally are looking for is for our lender partners to run everything through our automated system, and looking for, again, the total risk package of what do you look like as a borrower. So we're just looking for an accept feedback that they're going to provide. Probably a safe number, and I don't want to quote this, I don't want this written in stone. A 680 is a good one. Even a 660 higher could be a good one to be looking at in the product offerings. But I've seen sometimes some of the feedback that I've heard from loan officers that use our product offering, running it through our automated system, they've told me that they've been surprised at some of the accept feedbacks that they're getting. So, I don't want to tie it to an actual FICO. Because I don't want you to focus there so much as your overall credit.
And Tanya asked the question, and Tanya, sorry, I clicked that I answered it, but I didn't. Tanya asks if you've got, basically she's saying she's got a couple of different jobs. How does that factor into overall income requirements? And then she's got a question about basically seasoning. How long do you have to have those extra jobs in order for them to be considered, the income to be considered?
Normally, we're looking at a 2-year seasoning, 2 to 3 year seasoning on a lot of those, but it really depends. Because if you're still in that same line of work, right? You may have a different job, right? You may go from one job to another, but you're still in that same line of work. Does that make sense?
Yeah, I think so. So, Tanya, just because you have multiple jobs, or if you're saying you've had multiple jobs over the last 2 years consecutively, but not at the same time, either way, explore homeownership. If you're in the same field, that's continuity of profession, even though you may not be in the same job. As far as using second or third job income to qualify, if you've got, a side gig or something, maybe depends on how long you've been doing it and the consistency of the income.
Right. And kind of, and to add to that, Sean, if they have 2 or 3 jobs currently, they qualify on their primary job and it keeps their income below that 80% of area median income for Home Possible. The lender doesn't even have to look at the second and third jobs to qualify. And they don't have to use that in consideration for Home Possible.
Yeah.
That said, though, just because Home Possible may not be looking at it or needing that income, when it comes to some of the down payment programs that are out there, they likely will need to be utilizing that.
Okay. So a couple more here, and then I think we'll wrap it up. Angel, she's got a good one here. And we still have a lot of people on. She says, can a full-time college student with employment income qualify for these programs, or are students ineligible? Angel, separate student from employed. You've got income, you can qualify for a mortgage. Good that you're a student, good on you, keep going. But there's nothing there that prevents you from buying a home. So go do it. A couple questions here about Chapter 13. Would a lender work with someone in Chapter 13 that doesn't end until next year? And how does a discharge Chapter 13 impact the underwriting process? So walk us through Chapter 13 implications. Sandra, if you don't mind.
Oh, me? Okay. Sorry about that. So for Chapter 13, as long as you are in an active bankruptcy, you would not be eligible for a loan with one of the GSEs. Once it is discharged, what would have to happen is, I believe a BK is 7 years. They need to reestablish their credit and then be able to purchase.
Yeah, I think there are some exceptions to the 7-year rule, especially recently.
Yes, and depending for the reason for the bankruptcy. Absolutely, you're correct.
Yeah, but definitely got to get through the bankruptcy and get discharged, though, right?
Yes.
Okay. All right, let's see. Let's do maybe one more. Tasha says, I own a small piece of land in Mississippi. Can you obtain down payment assistance for a construction loan? And no, not for the construction loan, but she also asked, and we should clarify, what's the difference between a construction loan and a builder's construction loan? I think what she's saying is, I own land, can I finance the construction of a house? Versus what we would commonly call new construction properties, where some developer is taking care of all that. They're just selling you a home the day that it's done, and they get a certificate of occupancy.
Right.
But Tasha, yeah, there's no down payment assistance for construction loans that we're aware of. You'd have to talk with probably some commercial lenders for, I don't know, that's outside our purview here. We're all single family people. All right, we got one more here. We'll end with this. How about that? We got two more actually. Maureen, she's asking, how do you sign up for credit counseling? She's got a 706 FICO. She thinks I'm inferring here that she thinks she needs a lot of time before they may qualify for a home. Let's end with that. That's a great scenario. Sandra, 706 FICO. Call it a 606, whatever. Everybody on this call is different. You're in a different place. You're in a different part of this journey. What's the next step here as far as credit counseling? And if there's a slide you want me to point to, I'm happy to do that.
If you could go to our Borrower Help Center slide, that particular slide, there's a link right at the bottom there that will identify all 14 of our Borrower Help Centers. as well as our 15th, which we call our network that's in Orlando, Florida, which takes callers from all over the country as well. But you can certainly search there, or as Maheen had stated earlier, you can always look at the CFPB website, and within there you can also locate some HUD-approved counseling agencies in addition to what we are providing here for you. And they can certainly walk you through that entire process of credit counseling.
Good deal. So let's put some contact info up here. If you have questions for us about down payment assistance programs, you can reach out to us at info@downpaymentresource.com, or you can go to downpaymentresource.com and you can search for down payment assistance programs anywhere in the country, wherever you want to buy a home. We want to thank you for joining today. We've still got a big crowd. Sandra, final words, final directions for our audience today?
I first want to thank all of you for attending, because this is great. It's showing that you really are interested, engaged, and wanting to take that step in homeownership. And I applaud all of you for taking that step and being a part of this webinar with us to learn more about how to find a mortgage option that is attainable, sustainable, and responsible to help me make that dream of homeownership a possibility. So thank you all for being a part of this.
Well, thank you for joining us today, Sandra. For everybody else, keep at it. Keep at it. We're here to help. You've got a lot of resources, and go use them, especially the free ones. Take care, guys. Have a great day. Good luck on your journey.
Adios, everyone.